as you know, I've been warning about inflation for a year and a half. I think the Fed and the fiscal authorities so way overdid it, particularly the Fed on liquidity. They are so far behind the curve that we have a lot of inflation that is embedded in, and the Fed is going to have to hike many more times than what the market expects. I would not be surprised to see the short rate at 2% or even higher by the end of next year.
By the end of 2022. And what happens? Stocks can't be priced for that. I don't think the bond market's not priced for it. What happens to PE ratios? What happens overall to valuations, Professor, in the face of a more aggressive Fed like that?
Well, there's going to be tremors, but you know, look what happened when Powell pivoted. We had a week of tough stocks, and then people said, "Hey, where am I going to go? Where are you going to go in an inflationary environment?" I mean, stocks are real assets. I want to hold real assets. I don't want to hold cash. Bonds are, you know, they've held up because bonds have become a hedge asset against short-term fluctuations in the stock market. So they have a kind of a big short-term hedge demand. That's one reason their rates haven't gone higher. But basically, people will still they'll shudder, and we'll have what you could call taper tremors. But I don't think you're going to have a bad stock market. Certainly not the first half. I think once they begin to say we've got to go much faster than what we thought we did, then it's going to be tougher, I think, in the second half of 2022. Still, I think they're going to have enough market for stocks next year.
Professor, I just want to back you up on that because I have got a running total of this. The S&P is up 3% since Fed Chair Powell on the 30th of November came forward and said we need to be more aggressive here. And it's actually up 2% or 1.8% since the Fed meeting where they increased the taper. So the stock market, and by the way, that's in the face of 26 extra basis points on the 2-year note. So it's taken that piece and the question about the other piece. But Professor, all right, let me get to one other call that you've made here, which is you think finally this is the dawn of value stocks here over growth, and that's because of the environment that you see out there?
Yeah, I mean, I think, I mean, you know, I don't think NASDAQ is up that much. I mean, certainly those high flyers really that doesn't have earnings really got hit since the Powell pivot. And I think what you're going to see in a higher yield environment is people really saying, hey, do I want to own these stocks that have no earnings, no dividends, no cash flows, discounted all the way out to the future? You know, listen, you know as well as I do, Steve, you can't go to tips today. They're negative 1%, which means you lose money by investing in them. Where are you going to get positive after inflation yield today? Maybe some real estate and stocks. It's just not going to be bonds. So people, I think, in their shift to where am I going to get positive after-tax real returns will rotate still to the stock market and likely rotate to the value stocks and away from the growth stocks that have done so extraordinary in the last 2 years.